Hi everyone, welcome back to Saheb Academy. Today in this third video of cash flow statement chapter, we are going to solve our second problem, and the question is from ICAI study material illustration 7. The name of the question is Sun Limited, as we can see over here, and in just previous video we have solved illustration 6, the Ryan Limited, and in first video we have seen the whole concept of this chapter with adjustment, format, technique and lots of things, right? So please watch the previous videos first and then only come back to this video. Okay, if you are already clear with the concept and all, then let's just go ahead, let's solve this question. Now see here, let's just read this question and understand what has been said over here. What kind of method do we have to apply, right? What all ledger accounts we have to open, what all adjustments are there, how to read the question is very important. Okay, so let's see here, the balance sheet of Sun Limited as at 31st March 2021 and 2020, whereas the balance sheet has been given 20x1 we can read it as 2021 and 20x0 we can read it as 2020. You all know that. So 2021 is our current year, 2020 is our previous year. So this will be our opening balance and this will be our closing balance. You all know previous year's closing balance becomes opening balance of the current year, right? So that's why opening balance. Fine. All right. So first we have share capital. Note number 1. We can see over here from 50,000 it has become 60,000, isn't it? That's how you have to see, right? From previous year to current year, right? From opening balance to closing balance, what has happened? What is the change? Isn't it? That's how you have to interpret things. Fine. So 10,000 increase has happened. Let's just go to the note number 1. There we will have the complete proper clarity. Okay. So see, in note number 1, see share capital, equity shares, from 50,000 it has become 60,000. So 10,000 increase. Why 10,000 increase has happened? You have to check adjustment, whether there are any adjustment regarding that. If there are any adjustment, then you will have to open the ledger account of share capital and do the adjustment and find out how much issue has happened, how much buyback has happened and all. Is it clear? But right now there are no adjustment in this question regarding this. So this is simply issue. Okay, from 50,000 it has become 60,000, which means 10,000 face value of shares you have issued. Is that clear? Simple, understood. Okay, so you don't always have to open the ledger account. Sometimes you can just open the ledger account in your mind only. See, share capital account, it's a credit balance account, opening balance over here, closing balance over here, right? So 50,000 over here, 60,000. How it became 60,000? Because you have made an issue. Okay, that's how it is. So what are you going to do about this issue of shares? It's really simple. It's a financing inflow of cash, right? So you will just add it in financing activity. Is that clear? Proceeds from issue of share capital. Is it clear? Okay, fine. Next we have reserves and surplus. Note number 2. Let's go to note number 2. See, note number 2, reserves and surplus. What has happened? We have profit and loss account balance. Okay. From 4,000 it has become 5,000. 1,000 increase has happened. What is this 1,000 increase? This is the profit that you have retained after appropriation. After doing all the adjustment, what's the profit that is left? 1,000. That's what it is. Okay, that change, 1,000 change. Fine. So now that is helpful when we don't have net profit before tax, when we don't have net profit after tax. What we have to do? We have no option but to start from retained earnings or retained profit, right? And then do all the adjustment, isn't it? We reverse all this, we reverse tax provision, we reverse extraordinary items, then we reach net profit before tax. But now we have to see in the question whether we have net profit before tax or not. Okay, is that clear? Right now we don't know. So let's just see. Fine, we understood regarding reserves and surplus. Moving on, then see we have trade payables in the balance sheet. Trade payables is a current liability. Yeah, it's an operating current liability. What are we going to do with that? We are going to consider it in working capital changes. Yeah, if we are doing indirect method, isn't it? Yes. See, from 2,500 it has become 4,000. What has happened to trade payables? It's increasing. It's increasing by how much? It's increasing by 1,500, isn't it? So what are we going to do? We are going to add this. Is it clear? Fine. And then we have other current liabilities. Note number 3. Yeah, what are these other current liabilities? We have to go to the note to find out. See, in other current liabilities we have dividend payable. You all know whenever we have dividend payable or proposed dividend and all, always we open ledger account because there will be some kind of adjustment regarding that. Okay, even if there are no adjustments, still prepare the dividend payable account and just take the balances and find out properly everything. Okay, fine. So dividend payable is there. See, opening balance is there of 1,000 and there is no closing balance. Fine, we'll come back to that. Right now we'll just star mark it. Okay, we have to open ledger account, there will be some adjustment of that. Fine, moving on. Then we have the C point over here, short-term provision for tax. Yeah, in the balance sheet we have provision for tax. How much? 1000 opening balance and closing balance is 1500. So what does that mean? We have to open ledger account. Always remember, dividend payable, provision for tax, always we open ledger account. Fine, okay, we'll open ledger account of that. We'll see. Let's move on then. Then see, we have here assets, non-current asset, property, plant and equipment, PPE, right? So note number 4, there is a note regarding that, which means if you go to the note, you will find out what kind of PPE do we have. Yeah, and then which kind of accounting treatment is being done, whether they are following charge method or accumulated depreciation method, which means provision for depreciation method. That also you will come to know. So it's very important, you have to look in the note properly. See, property, plant and equipment, see, at WDV they are saying, which means you have written down values over there. It's not at original cost. Okay, so mostly accumulated depreciation will not be there. See here, accumulated depreciation is not there. Yeah, you just have WDVs over here, which means they are following charge method. Directly they are charging the depreciation and everything in the PPE account only, in the asset account only. They are not opening provision for depreciation or accumulated depreciation account. Is it clear? So your work becomes simple. Yeah, your solution becomes simple. Yes. Now see in the PPE note, what are they saying? See, first you have building. Now what has happened in the building? Let's just see. Opening balance is 10,000, closing balance is also 10,000. There has been no change. There has been no purchase of building, sale of building, nothing has been done. Okay, no depreciation also, right? So you know, you will just completely ignore this. No effect of this will flow in the cash flow statement. Is it clear? You will just ignore this building. Fine. Then we have fixtures. Now what has happened in fixtures? See, from 11,000 it has become 17,000. So there is an increase of how much? 6,000, right? Why this increases happened and all, you know, there is an adjustment for that. Okay, see here. Let me just show you the adjustment. See here, there is an adjustment regarding fixture and regarding vehicles. So definitely we have to open ledger account of fixtures as well as vehicles. For fixtures they are saying depreciation is this much. For vehicles, see here we have vehicles also. If you'll see vehicles, how much? 12,500, 8,000, right? Opening balance is 8,000 and then closing balance is 12,500. So for this also there are what? There are adjustments. See here they are saying vehicles, depreciation for the year, proceeds on disposal of vehicles. Yeah, we have sold a vehicle, yeah, and we have realized this much, and then written down value they have given of the sold vehicle 1,000, and then profit on disposal is there. So definitely we have to open the ledger account for that. Okay, so we will now just star mark it. Then what do we have? See here, if you'll see in the current assets, then we have current investments. Now understand, current investment, some people think, some students think we have to take this in working capital changes because it's a current asset. It is a current asset, but understand it is not of operating nature. It is of investment nature. We have invested the money. Do you understand this? Current investment, we have invested. So it will come in investing activity. Fine. And then some of the students might confuse this as what? Cash equivalent. They think we have invested the money, right? So it's an investment. So they think it's kind of like marketable securities. No, it's not a marketable securities. You have to take this under investment activity only, like a normal investment. You will not consider this as cash equivalent. Fine. You can make an assumption, but it's not good. Okay. It wouldn't be a rational assumption. ICAI doesn't make it. So that's why you will take this in investment activity. Okay. What is happening to this? From 1,000, it is increasing to 2,000. So it is increasing by how much? 1,000. Right? Opening balance is 1,000, closing balance is 2,000. So 1,000 increase has happened. Why it has increased? There is no note, nothing, no adjustment. So easily you can make a proper assumption that, you know, we have purchased more current investment. Yeah, we have invested more into this current investment. How much? 1,000. Purchase of investment. It will be subtracted in investment activity. Is it clear? Simple, understood. Then we have inventories. Inventories are what? Current asset, operating current asset. So we will take this in the working capital changes, isn't it? From 14,000 it has become 17,000. It has increased by 3,000. When current asset increases, negative impact on cash. You have to subtract in working capital changes. Fine. And then trade receivables. This is also a current asset, operating current asset. What you will do? You will take this in working capital changes, right? From 6,000 it has become 8,000. Current asset is increasing by 2,000. So what you will do? Negative impact on cash. You will subtract 2,000 in working capital changes. Fine. And then you have cash and cash equivalents. What do you do of this? This is also what? This is also a current asset, but you can't take this in working capital changes. What do? This is the last item in the cash flow statement. This is the last item. You take the opening and closing balance, right? At last. So that's what you have to do over there. Fine, simple. Okay, see cash and cash equivalents. Note number 5, right? See 8,500 cash we had in the beginning of the year. From 8,500, what has happened? It has decreased to 4,000. It has been decreased by 4,500. It has been decreased by 4,500, which means in the current year, we have used this much cash. How much cash? In net, overall net, we have used this much cash. Okay, so if you do the cash flow statement now, okay, if you add up all the activities, operating activities, investing activities and financing activities, the net cash flow should be decrease of 4,500. In your business in this current year, 4,500 cash has been decreased. Is it clear? That's what you can understand from over here only. Fine. Yes. And then see, we have some adjustment over here. No, these are not adjustments. See, profit and loss information is been given over here. See what they are saying. The profit and loss statement for the year ended 31st March 2021 disclosed profit before tax. Yeah, profit before tax is given to you. So that means you don't have to do anything. You don't have to take the retained profit, reverse appropriation, reverse provision for tax, reverse extraordinary items and all. That thing you don't have to do, because directly they have given you NPBT, net profit before tax. What has been given to you? This thing has been given to you. Now you just have to do what? You just have to look over here, right? Whatever that is non-cash, non-operating sitting over here, just reverse. Right, reverse non-cash, get rid of outsiders and do changes in working capital, subtract tax paid, yeah, and then consider the extraordinary items over. Your cash flow statement is over. That's what you have to do. Yeah, I'm talking about indirect method, operating activities, right? So it's given over here. Directly you can start from 4,500. Okay, but then they have also given you, see, tax expense, current tax. What is this? This is the provision for tax that you have made in the current year. Always remember, this tax expense is not tax paid. See, this information is coming from profit and loss. In profit and loss statement, we always have provision for tax that has been made in the current year. Only that much. Okay, opening balance of provision and closing balance of provision you will find in the balance sheet. Okay, fine, understood. Then see, they have given you profit for the year. Profit for the year means profit after tax, net profit after tax, NPAT, that is 3,000. And then declared dividend. This is the final dividend. Okay, so final dividend has been declared of 2,000 in the current year. Okay, fine. And then retained profit they have given 1,000. You see, I told you over here only. From 4,000 it has become 5,000. 1,000 difference is there. Yeah, 1,000 increases happened. Why is that? That's the retained profit. You can see from the profit and loss statement. Okay, see what happens is, think about the final accounts, financial statement of companies. Okay, when you get the retained profit 1,000, where does this go? This 1,000 goes and gets added with the retained earnings, previous year's profits, accumulated profit, 1,000 plus 4,000, the closing balance becomes 5,000. This is what has happened while preparing the balance sheet and profit and loss statement. Right now we are preparing cash flow statement from these financial statements, so we can understand over here how it has come and all. Is it clear? Okay, then what they are saying, see, let me just show you. Yeah, further information is available. It's kind of a long question. Okay, it's not coming in one paper, so I have to, paste this. So see here, further information is available regarding fixtures, depreciation for the year. All right, and then vehicles, we already discussed this, right? Depreciation for the vehicles is given over here for the year, and then we have sold a vehicle for 1,700. The cost of that, sorry, not cost, written down value of that was 1,000. Written down value means what? Cost minus accumulated depreciation. Whatever depreciation is there, yeah, till the date of sale, if you subtract that, you get written down value. Fine. So that is already given. You don't have to calculate and all. Directly you can take this in the ledger account, and then profit on disposal is also given. Okay, we'll prepare the ledger account and we'll see. Prepare a cash flow statement for the year ended 31st March 2021. You see, here they are not saying any method. Yeah, they are just saying prepare cash flow statement. So what are you going to do? Question is silent about the method, but you have to understand so much information is given. balance sheet, right? And then yeah, two balance sheets are given. See, 2021 balance sheet and 2020 balance sheet. Two balance sheet are given. Profit data is given. So easily you can, get the hint from the question that, you have to apply indirect method, and that's what you have to do. Unless and until the question says, use direct method, you will not use direct method just by yourself when all this information is given. Is it clear? Okay. Sometimes you will have gross receipts and gross payments. At that time directly you can use direct method. Is it clear? But here such huge information is given, and then how can you use direct method? You can't use direct method. You have to apply indirect method. Okay, right. So now let's just prepare the ledger accounts. Now let's understand how to prepare the ledger accounts. It's really simple. Understand. You start from the balance sheet. Yeah, you are clear about share capital. You are clear about reserves and surplus, right? You are clear about trade payables, but you are not clear about other current liabilities, isn't it? Dividend payable. There is an adjustment regarding that. So we will open an account of that. That's how you have to go sequentially. Fine. Whatever that is confusing, you don't have clarity on that, open the ledger account. Whatever adjustments are there, opening balance, closing balance, take all in the ledger account and understand how it is impacting profit, how it is impacting cash. Okay, that's what you do. Fine. In indirect method. So see, working note number 1, we are preparing ledger account of dividend payable. So dividend payable is a liability account. It has credit balance, opening balance on the credit side, closing balance on the debit side. So in the balance sheet, there is only opening balance. There is no closing balance, right? So opening balance, see here, 1000, the 1000 opening balance, buy balance B by D, and the closing balance is 0 as given in the balance sheet. Then what you will do, then the question has said that we have declared a dividend of 2000. That also hits dividend payable account. Yeah, I have explained you the logic and everything. So dividend payable account will increase because dividend has been declared, right? So dividend payable account will increase because of profit and loss appropriation. Fine. By P&L 2000. Dividend declared in current year. Always remember, dividend that is declared in current year will come over here. Final dividend declared. And interim dividend declared and paid will also come over here. Okay, all right. So this is not helpful for us right now in this question. Yeah, why? Because understand, we reverse this in operating activity only when we start from retained earnings. When we start from retained profit, we reverse this to reach 4,500, to reach profit before tax. But right now we have profit before tax, so we are not going to do this. Is it clear? We are not going to reverse this in operating activity. Fine, understood. Then see, 1000 plus 2000, that's equal to 3000. 3000 on this side as well. 3000 minus 0, that's equal to 3000 only. This is the balancing figure we have found out on the debit side, which is the payment dividend that is paid in the current year. Okay, dividend payable will decrease now when the payment has been made. So dividend payable is decreasing because you have made the payment of dividend. Fine. So what will happen of this? This will be subtracted in financing activity. You all know this. Dividend paid is always a financing activity, right? It's always a financing activity. It's a service cost of shares. Okay, dividend paid. Fine. Okay, understood. Next, we are done with dividend payable, right? We took all the information of dividend payable in this account. We found out how much dividend has to be paid, right? Yeah, that's the objective of preparing ledger account. We get the clarity. Fine. Okay, and there are marks for this. Okay, you just have to prepare like this only in rough, just T and just fill the figures, but there are marks for this. These are important working notes. Then see, next what do we have? If you'll see over here, we are done with other current liabilities, right? Then see, sequentially we are going. Okay, no rush. Short-term provision for tax. We are not clear about provision for tax. Yeah, there is opening balance and closing balance, and then here also there is what tax expense, current tax, which means tax provision made in the current year, right? So we will open a ledger account for this. So provision for tax, it's a liability account. Yeah, debit means minus, credit means plus. Opening balance on the credit side, buy balance B by D. 1000 we will take. From where did we get this 1000? See, provision for tax, 1000 is the opening balance, closing balance is 1500. Okay, opening balance, closing balance. Clear? Simple. Then the question has said we have provided how much tax provision in the current year? 1500. Tax expense, current tax 1500. So this will come over here. Provision for tax has increased in the current year because we have made the provision. out of profit and loss. So by profit and loss 1500. Is it clear? Simple. Then you will balance this account. 1000 plus 1500, that's equal to 2500. 2500 on this side. 2500 minus 1500, that's equal to 1000. This 1000 is the balancing figure that we have found out. It's the tax paid. Provision for tax is decreasing because we have made the payment. Fine. Now in the previous video, in the illustration 6, there we had tax payable account. That's also same only. The same way you have to prepare. There is no difference. Is it clear? The same logic and everything. Okay. So this is the payment of tax. So now what will happen? The provision which we have made in the current year, this we reverse in operating activity only if we start from net profit after tax or retained earnings. Isn't it? You all know this. We add provision for tax in the beginning only when we start from profit after tax or retained earnings, right? But we already have NPBT now, so we are not going to do this. Same like this thing. Fine, understood. You see, dividend payable and provision for tax, both of these accounts are exactly duplicate. The same logic applies. Okay, yeah. And then what will happen of tax paid? You all know tax paid is an operating cash outflow. We have to subtract it in operating activity always. Whether we are doing direct method or indirect method, always subtract it in operating activity. Fine, understood. Then we are done with provision for tax also, right? Sequentially, just go sequentially. Next in the balance sheet, what do you have? Next in the balance sheet, you have, see, property, plant and equipment, right? Note number 4. So here we have building. We will not open any ledger account of building, isn't it? Because there has been no change in that, nothing, no adjustment is there regarding that. And we are not going to do anything about it in cash flow statement. But fixtures, there has been change, there are adjustments. So let's open fixtures account. We have star marked it, right? So fixtures account, fixture is an asset, right? So it has debit balance. Debit means plus, credit means minus. Opening balance on debit side, closing balance on credit side, right? See, opening balance on debit side, to balance B by D. How much? See here, fixtures, opening balance was 11,000, closing balance is 17,000. So 11,000 opening balance, closing balance is 17,000. Then what you have to do, you have to look, are there any adjustment regarding this? In the question, you know, they have given us depreciation for the year of fixtures, that is 1,000. 1,000 depreciation has been charged. When we charge the depreciation, what happens? See, understand, we are not opening accumulated depreciation or provision for depreciation. Simply directly we will decrease the asset value. Okay, that's what we have to do. So fixture account directly we will reduce. We will credit because of depreciation. Okay, by depreciation 1,000. Is it clear? What do you do of depreciation? It's a non-cash expense. We always add it in operating activity. You all know this. Fine, understood, simple. Then there is no adjustment regarding fixture, just that depreciation thing. So 17,000 plus 1,000, that's 18,000. Yeah, just balance this account. 18,000 on this side as well. 18,000 minus 11,000, we get 7,000 as the balancing figure, right? So this 7,000, what is this? What is this 7,000 on the debit side? You have to understand, you have to make the proper assumption. It is the purchase of fixtures. We have purchased more fixtures. Is it clear? Fine. Do you understand this? It's really simple. We have purchased more fixtures, so 7,000. So fixture is increasing because of purchase we have made and we have paid the money. It's an outflow of investing activity, right? So it will be subtracted in investing activity. Is it clear? Understood. So this is the balancing figure. Clear? Okay. So we have got clarity on fixtures also. From here, what we have to do in cash flow statement, we have to add 1,000 depreciation in operating activity and we have to subtract 7,000 in investing activity because we have purchased fixtures. Is it clear? Okay, understood. Then next which account? Next C, we have vehicles. We have star marked it. Why? Because we have opening closing balance, there is a change in that, and then there are adjustments regarding this. Yeah, vehicles. What has happened? Depreciation, and then they have said we have sold vehicles and got 1,700. Written down value of that was 1,000. We have made profit on disposal of 700. Yeah, so we'll open vehicle account. Now vehicle account is what? It's PP, right? It's asset account. So it has debit balance. So see, vehicle, debit balance. Yeah, debit means plus, credit means minus. Opening balance on the debit side, closing balance on the credit side. Okay. So what is the balance? The balance is, see, 8,000 opening balance, closing balance is 12,500. Okay. So opening balance, to balance B by D, 8,000, closing balance 12,500. Clear? Simple. Then the question has said we have charged depreciation of 2,500 in this year for vehicles. So charge the depreciation directly in the asset account. Vehicle account is decreasing. It's getting credited because of the depreciation. How much? 2500. What will happen of this? This will be added in operating activity. Clear? Understood. Then adjustment is saying, see, we have sold the vehicle for how much? 1700. So what are you going to do about that? Simple. Sell the vehicle. Vehicle is decreasing. Yeah, you are selling the vehicle means vehicle is decreasing, right? It's decreasing by the sale value. Okay, vehicle is decreasing because you have made the sale by bank. Yeah, you got the money, right? So bank account will come. You have made the sale 1700. This is the sale value you have taken. Fine. So when you sell the asset, fixed asset and all, what happens when you sell the PP? It goes in investing activity. It's inflow. You have sold and you have got the cash, right? So you have to add it in investing activity. Is it clear? Simple. Then they are saying we have sold it for 1000. We have made a profit of 700. So what we have to do? Simple. Profit will come on debit. Always remember, profit will always come on debit and loss will always come on credit. Okay, gain on sale, profit on sale will always come on debit. If you open investment account, if you open any PP account, remember this, write this somewhere. And the loss on sale will always come on the credit side. Okay, so 2 P&L, profit on sale, that's 700. Fine. What do you do of profit on sale? In operating activity, you have to subtract this. In operating activity, you have to subtract this. Why? It's a non-operating item. Okay, it's a non-operating item, so that's why you have to subtract, because it's sitting in the P&L as an indirect income. So you'll have to subtract and decrease the profit so that it can come to the cash basis, right? You all know the logic and everything. Fine. Next, what happened? Next, see, nothing else, right? That's all. So now we have to balance this account. See, opening balance we took, closing balance we took, depreciation they told us, we took this, and then they told we have sold for 1700, we took that, and then they told us we have made a profit, so we took the profit over here. Yes. Then we have to balance this account. 2500 plus 1700 plus 12,500, that's equal to 16,700. 16,700 over here also. 16,700 is not equal to 8,000 plus 700, right? It's not equal. So that means we have a balancing figure over here. So what we have to do, 16,700 minus 8,000 minus 700, that's equal to 8,000. So 8,000 is what is the purchase of a vehicle that we have made. Fine, in the current year. So that's what you have to take to bank, purchase. Fine. If there is a balancing figure on the debit, that means you have purchased. If there is a balancing figure on the credit, that means you have sold. Okay. So vehicle is increasing because of the purchase you have made of 8,000, and this is what? This is an outflow of cash in investing activity which you have to subtract. Same like over here, how you purchase the fixture. Here we got this as balancing figure. Here also the same way we are getting this balancing figure. Is it clear? Simple, right? You understood the logic and everything. So in these ledger accounts, all these red things are what? These are the balancing figures. This. Okay. Understood? Clear. So you are clear with the ledger accounts. Now once we are done with the ledger account, now we can easily prepare the cash flow statement because we have clarity now. Yeah, we have gone sequentially regarding everything. Next, see, we have current investment. Do we have to open a ledger account of current investment? If you want, you can open. Okay. See, current investment is an asset account, right? So debit balance, opening balance on the debit, closing balance on the credit. Yeah. Opening balance 1000, here 2000. Isn't it? Yes. So here 2000 you have, and here only 1000. So there is a balancing figure on the debit, which means you have purchased more investment of 1000. Is it clear? So if you want, you can open a ledger account, but it's not needed. Directly we can understand there are no adjustment in anything. So directly we can do that. Fine. So yeah, now let's just see how to prepare the cash flow statement under indirect method, right? We have to indirect method because two balance sheet are given and profit information is given. Let's just directly prepare now the cash flow statement. Now see here we have the actual cash flow statement. Let's understand how to put the figures and how to understand everything. So see here, Sun Limited cash flow statement. We are solving this as per indirect method for the year ending 31st March 2021. Okay. So first we start from cash flow from operating activities. Yes. And the starting point is net profit before tax and extraordinary items. Isn't it? That's our first priority. Yeah. If it's available in the question NPBT, we always start from that. If it's not available, then NPAT. If that is also not available, then retained earnings. But in this question, what happened? In this question, they gave us net profit before tax. Isn't it? They gave us net profit before tax 4,500. So we started from there, right? Then what do? You all know, if we are starting from net profit before tax, what we have to do, we have to just look over here, the indirect income and the indirect expenses. What all non-cash items are there, yeah, of non-operating that we have to reverse. What all, you know, outsiders are there which are non-operating but they relate to what? Financing and investing, isn't it? So we have to get rid of them as well, and then we have to do changes in working capital, and then we have to subtract tax paid, and then we have to consider extraordinary items. Then only finally we will get what? Cash flow from operating activities, right? Yes. So let's reverse non-cash and non-operating items. First, let's just look in the ledger accounts. Always do that, okay? We have prepared ledger account with so much detailing, right? So in the ledger account, see, we have taken operating activity over here, yeah, minus operating. So can we subtract that right now? No. Yeah, this is tax paid, this will come at last. If you look in the fixture account, here we have depreciation, and in vehicle account also we have depreciation, 1000 over here and 2500 over here. We have to add this in the operating activity because it's a non-cash expense. So let's add back depreciation. Yeah, depreciation you have to add 1000 of fixture and 2500 of vehicle. So that's 3500 we have to add. Now it's not necessary that you have to do plus over here, okay, plus sign. Directly you can just write a positive figure, which means you are adding. Okay, fine. Next, what else is there? See, next, if you see in the vehicle account, we have profit on sale of vehicle, right? So profit and sale is what? Profit and sale is an indirect income. In the P&L, it has been added. So we have to reverse this. Reverse means you have to subtract right now, okay? In the cash flow statement, you have to subtract. So profit on sale of vehicles, 700 you will subtract. Is it clear? Okay, here you have, right, profit on sale 700. This was added in statement of P&L as an indirect income. But now in cash flow statement, you are reversing this. So you have to subtract. Is it clear? Simple and straightforward. Then if you see, there's nothing. No non-operating items or non-cash items and all. So it's all over. You can also check in the adjustment or balance sheet if there are anything. There's nothing. Okay, nothing. So that is why what you have to do, you have to go forward. Okay, so you have to calculate the operating profit before working capital changes. 4500 plus 3500 minus 700, that's equal to 7300. This is the operating profit before working capital changes. Now what you have to do, where you have reached, can we see the actual format that we saw in the conceptual video? See, you started from net profit before tax and extraordinary items. You reverse non-cash and non-operating items, only two were there. And then you reverse items to be considered in other heads like interest that we have, not paid actually, interest expense, interest income, dividend income, but there are any in this question. So that's why you have reached directly to operating profit before working capital changes. Is it clear? Now you have to just give the effect of changes in working capital, which is really simple. See, what you have to do for this, you just have to go in current liabilities and current assets. If you go in current liabilities, you have only one operating current liability, that is trade payables. From 2500 it has increased to 4000, isn't it? It has increased to 4000. You all know the trick of working capital changes. Current liability is positively related with cash. Whenever current liability increases, cash also increases. That means you have to add. Okay, simple. So it has increased by 1500, so you will add. Current liability is increasing, trade payable is increasing, so you will add it. Increase in trade payables 1500. Clear? Simple and straightforward. Okay. Next, you had other current liability, which was dividend payable. For that, we have made a ledger and separate adjustment is there. Isn't it? Dividend paid, we have found out. It will be subtracted in financing activity, right? In operating, nothing you have to do. Okay. Declare dividend also, you don't have to reverse because we have started from NPBT. Okay, fine. So only one working capital changes was there in current liabilities. Provision for tax also, we don't have to do anything about that over here. Yes. Then in current asset, we have current investment. Current investment, we are not going to consider that. It's an investing activity. I told you. Inventories we have, that's a current asset. Operating current asset, we do take it in the working capital changes. So from 14,000, it has increased to 17,000. Increase of how much? 3,000. Current asset increased by 3,000. So what you're going to do? Current assets are negatively related with cash. If current assets are increasing by 3,000, that means 3,000 negative impact on cash. So you will subtract it. Increase in inventories, 3,000 you will subtract. Is it clear? Simple. Then what happened? Sequentially we are going, okay, slowly sequentially we are going. Then see, we have trade receivables, which is also a current asset, operating current asset. From 6,000 it is increasing to 8,000, 2,000 increase. 2,000 increase in current asset means you have to subtract again. Increase in current asset means negative impact on cash, you have to subtract. Is it clear? Simple, understood. Then what? Then is there any more current asset? See, there are no current asset. Cash and cash equivalents we will take at last, not in working capital changes, you have to ignore. Okay, fine, understood. So nothing else, right? So 7,300 plus 1,500 minus 3,000 minus 2,000, that's equal to 3,800. This is what? Cash generated from operations. Okay, this is cash generated from operation. After working capital changes, this is what you get, cash generated from operations. Now what you have to do? Now you have to subtract the tax paid. You all remember, right? You have to subtract the tax paid. Tax paid, net of refund you have to take. And then if there are any extraordinary item, that also you have to consider over here. Add or subtract depend upon the question, what kind of extraordinary item you have. Okay, if it is causing inflow, you will add extraordinary item. If it is causing outflow, you will subtract that extraordinary item. That's how simple it is. Okay, so see, tax paid we will take. Now from where did we get this 1,000 tax paid? Ledger account we have prepared now, provision for tax, right? To bank, how much? 1,000. 1,000 we have to subtract in operating activity. So tax paid minus 1,000. Is it clear? Simple and straightforward. Then what? Then nothing else, it's over. Net cash generated from operating activities. There are no extraordinary items, right? So directly you have got how much cash we have generated. See, it's a positive figure. 3,800 minus 1,000, that's equal to 2,800. So if it's a positive figure, that means from our operations in this year we have generated, we have a net inflow of 2,800. Is it clear? Simple and straightforward. Now you have to move on to the investing activity. Okay, so in investing activity, what do we take? We take all the purchase of assets, sale of asset, any income we get because of the investment, all these things, right? So see here, cash flow from investing activities. So first just check the ledger account. Okay, always remember this, just check the ledger accounts. In ledger accounts, in dividend payable, there is nothing. In provision for tax also there won't be anything. But in fixture, this is what? This is an asset, long-term asset, right? Fixture, vehicle, these are PP. So always PP are very important for investing activities because you have invested your money in PP, in long-term assets, right? So see, you have purchased fixtures. This has to be subtracted in investing activity. Okay, so 7,000 you have to subtract. Purchase of fixtures, 7,000 minus. Is it clear? Do you understand the logic? Okay, next, see, vehicle also you have purchased of 8,000. This also you have to subtract in investing activity. You have purchased the vehicle, but the cash is going out, right? Because of this. So purchase a vehicle you have to take minus 8,000. Is it clear? Simple and straightforward. Now purchase also comes in investing activity. Purchase of assets as well as sale of assets will also come. So have you sold any asset? Yes, you have sold an asset for how much? 1,700, right? So that will also come over here. See, sale of vehicle 1,700. But when you sell the asset, what happened? It's an inflow. So you have to add that. Is it clear? Simple and straightforward. You have understood this. Okay. Then what do we have? After doing all the ledger account thing, then see what is missing in the question. Okay. For which we have not prepared the ledger accounts. See, for current investment, we have not prepared a ledger account. Directly in our mind only, we know no adjustment, nothing is there. Directly we know from 1,000 it has become 2,000, which means 1,000 more we have invested in current investment. 1,000 outflow is there. So that's an investing activity. We are investing more into it. Is it clear? So purchase of current investment. Okay, we have purchased more current investment of 1,000. So that also you have to subtract. I told you now, current investment, we will not take it under working capital changes. We will not consider it as cash equivalent because there can be risk in it or the maturity period is more. Okay, so that's why we are not making any assumption regarding that. Directly we are considering it in investing activity as ICAI has done. Is it clear? So purchase of current investment minus 1,000. Is it clear? Simple. So everything else is over, right? So now everything is over. See here, there is nothing else regarding investing. Yeah, the main thing was PPE only, and then nothing else. We have not earned any interest, earned any rent and all. Nothing else is there. So that's it. So what we have to do? we have to just make a sum of this and we'll get the net cash. See, minus 7,000 minus 8,000 plus 1,700 minus 1,000, that's equal to 14,300. Is it clear? We are getting a negative figure. Mostly in investing activity, you will get a negative figure. Negative figure means this much money has been used in investing activities. Okay, net outflow has happened in this year because of the investing activities. Yeah, net cash used in investing activities. Is it clear? Simple and straightforward. You have understood this, right? Now let's move on to the financing activity. Now in financing activity, what will happen? Again, go to the, what do you say, question only. Okay, in the question, if you see, first we had share capital for which we did not open ledger account, right? From 50,000 it became 60,000. We said it was because of issue of shares. Yeah, we have not opened ledger account of this. Mentally we know that it's just an issue, no adjustment, easily we can take it. So let's just take it right now. Proceeds from issue of shares. Yeah, we have got 10,000 money. We have not issued at premium. We have issued at face value. Yeah, only that much has happened, right? See, you can see the difference from 50 to 60, 10,000. So 10,000. Is it clear? If we issue at premium, then the whole amount you will take. Okay, you will take the issue amount. Face value plus premium together only, combined. Is it clear? Okay, next see, in the ledger account, what do we have? In the ledger account we have, see, dividend paid, isn't it? If you see here, there is not any cash flow from financing activity, and in fixture also it's not there, in vehicle also it's not there. It's just in dividend payable. In dividend payable account, we have found out how much dividend has been paid in the current year. How much? 3,000, right? And dividend paid is a financing cash outflow, so we have to subtract it. Yeah, we have paid the dividend, money is going out, so we have to subtract it. Simple. Dividend paid 3,000, and then nothing else. Okay, nothing else. See, is there any interest paid? Are there any debentures over here with the rate given so that we can calculate and all? No, nothing else is there. So that's all. So 10,000 minus 3,000, that's equal to 7,000. This is the net cash generated from financing activities. Is it clear? Because only two items were there and we have taken that, and that's it. Fine. After this, what you have to do, you all know, we make a sum. 2,800 minus 14,300 plus 7,000, that's equal to how much? That's equal to 4,500 negative. Yeah, shall we do it in calculator? See, it's really simple now. 2,800 minus 14,300 plus 7,000, that's equal to 4,500. Yeah, we have made a sum of all the three: operating, investing and financing, and we have got what? 4,500 as the net cash outflow. Yeah, I told you in the beginning only, in the balance sheet, the cash has decreased from 8,500 opening balance to 4,000. How much decrease has happened? 4,500. So see, our answer is right. 4,500 decrease has happened. Is it clear? Net decrease, you will call this, in cash and cash equivalents. How we have found this out? Operating plus investing plus financing. We'll just make a sum of that. Fine. Okay. So then what will happen? Then we will take the opening and closing balance. Yeah. Opening balance is 8,500. Closing balance is 4,000. Yeah, that's what we have to take. Cash and cash equivalent at the beginning of the period, 8,500 opening balance, and then closing balance of cash and cash equivalent, 4,000. So right now, if you just check, you can verify minus 4,500 plus 8,500, that's equal to 4,000. So our answer is right. Is it clear? So this is how you have to prepare the cash flow statement under indirect method. Okay, it was a really simple question. It's just that, you know, we understood over here how to prepare the dividend account and all, isn't it? It's almost similar. But let's just say, for example, let's just say net profit before tax was not given. Then what you would have done? What you would have done? See, it's really simple. If net profit before tax was not given, then you would have started with retained profit, 1,000. If this was also not given, then what you would have done? 5,000 minus 4,000. Closing minus opening, you would have got 1,000. That would be your retained profit. You would have started from there. Okay, in the working note only you can do as ICAI does. Okay, most of the times. See, retained profit 1,000. This is a potential working note. Okay. Yeah, so retained profit 1,000. Then you would have reversed all the appropriation things. For example, interim dividend paid, final dividend declared, transfer to reserves. In this question, what do you have? In this question, you have dividend that we have declared 2,000. Actually, you will take the figures from the ledger account, 2,000. This you will reverse. Fine. So final dividend declared, you will add back. Normally it is deducted in appropriation, yeah, because it's a distribution. So you will add it back. You will reverse it. So it will become 3,000. You will get net profit after tax, and then you will reverse the tax. See, here tax you have 1500, isn't it? Provision that you have made in the current year. So that tax provision you will add back 3000 plus 1500. Okay, and then if there is any refund of tax, that also you have to subtract. If there is any extraordinary item, that also you have to reverse by doing opposite to what has happened in P&L. So ultimately you will reach at where? You will reach at net profit before tax 4500. Is it clear? This is how you have to do it. Okay, see, from 1000 the retained profit after all adjustment, we reach to 4500 profit before tax. Okay, this is what you would have done if you didn't have net profit before tax in the question. Is it clear? So this is a potential working note, not a working note, potential working note. All right, so I hope you have understood. That's all for this video. You have clearly understood everything. Okay, yeah, so if you have any doubts and all, just comment down below or just take in screenshot and ask me in Instagram. The notes will be uploaded on our Telegram channel, Saheb Academy 7. You can get all the notes from there. Okay, right, so that's all. See you in the next video. Bye.